Good Monday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, Dima?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. And before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Awesome.
And with that, let me share my screen. If you guys are joining us for the first time and you have a question, or anybody for that matter has a question, you could put that question into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on the show and ask your question live and direct, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, you could click on raise your hand. There's a button, raise your hand. Click on that. You don't have to turn on your video camera. Everybody could hear you once you come in, and then you could ask your question live and direct. So while we're waiting for any questions to come in, what I'll do is I'll start out looking at the pre-market report, see what stocks are doing in the pre-market hours. I also had some questions over the email, and I think one left over from Friday on the options chain. So on the options chain, it had to do with standard deviation, average moves. I'll take a look at that. Over the email, had some different questions. One was on option order flow sentiment in SPY. So we'll take a look at that, go through that. But if any questions come in, Will, let me know. And
yeah, we did have one question from a newer chameleon, Luis, who's been on every day for about the last week, was asked a question about screening or finding cash secured puts. Where would he go for that?
Okay. So to screen for puts and cash secured puts are basically selling naked puts. That's what it is. Under screeners up here, I'm hovering over there. You have on the right hand side a bunch of different screeners, and over here naked puts, single leg strategies. This is the second one down undercover calls. Click on that, and that's basically a screener for your puts from the sell side.
There you go.
So if that was it, let me start out with the pre-market report, and then I'll move on to maybe the option order flow sentiment and then the options chain. All right. So this is the pre-market report. These are stocks trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 41 stocks made our percentage gainers list, 152 in a percentage decliners. So from this perspective, we're looking like we're set up for more bearish bias at the open. I'm going to filter out this list to just S&P 500 stocks. So we want to take out low cap stocks, ETFs, leverage products, closed-end funds, preferreds, anything that's not in the S&P 500. To do that, I'm going to use this filter here in ETF. I'm going to drop it down, and by selecting one of these ETFs, that filter is going to filter out the table below for stocks that are holdings in that ETF. So SPY, that's the S&P 500 ETF. This list now is filtered out by the holdings or components in SPY, which is the S&P 500 constituents. So far, 0 made our percentage gainers list, 30 on the decliners. So again, here we're looking like a more bearish bias at the open. So if there are no questions, I'll move on to SPY order sentiment. Okay, you're on mute.
Sorry about that. That's perfect. No other questions.
Okay, so SPY. So I'm going to come down here, SPY option order sentiment. And down here, so we see here that the net delta on a day was positive 7.5 million. And this question, I think I've answered several times, but the question keeps coming up. So why is the order sentiment or the net delta positive on a day that the stock is down 3.4%? And we're going to go through this example. I'm going to show, we're going to go through some of these options and then get some more insights. But a couple things here when we read the order sentiment, and it's important to understand that order sentiment is not a predictor or of what the stock will do. It's looking at the order flow and interpreting which way the order flow is flowing. Okay, so, and it's converting that order flow into a delta. So it's looking at it from two sides. One is looking at it from the dealer side, where the dealer is providing liquidity, making a market, and the assumption is that the dealer is there to balance the books, not to take a directional risk, but hedge the risk by hedging the delta of the trades. And on the other side, we're looking at order flow comes in from customers, institutions, professional traders coming in through their brokers into the market. Some of them get matched up, some of them trade against the market makers or dealers. And that's what this is trying to do, is look at the trades and interpret which ones look like they're trading against the dealers. And based on the interpretation of it, it converts it to the volume into a delta volume or directional risk. Okay. So on the day, we see 7.5 million net long deltas. So I'm going to come over here. We see here's the deltas that were long, short. So 123.8 million long deltas versus 116.3 short deltas, giving us a net on balance 7.5 million deltas long. So let's take a look at that really quickly. Here's how it progressed throughout the day. And here we see kind of a breakdown. More put selling than put buying, more call selling than call buying. And here we have the top deltas. And one thing to notice in SPY, so before we even get to that, let me first spin back here. And the one thing that heading into Friday as a trader, you should know, because we talked about it, it was on the news. If CNBC, Wall Street Journal, Bloomberg, no matter where you read, we know that Friday was a major market moving event because the Fed was speaking, Jackson Hole meeting with the Powell, giving an indication. This was widely anticipated that he's going to give some indication of what the Fed is feeling about the economy and future interest rate hikes. We know that the market's been rallying for a while now because they thought that they were going to pivot. And then on Friday, everybody was anticipating that. We knew it could create volatility, and they went the other way, saying, no, we're not done. We're going to be raising interest rates a lot more. So the volatility that we saw on Friday down should not be a surprise, because this was very well telecasted and anticipated, right? So we kind of all knew what that Friday could be a major market moving event, especially that the message was much different than what the market started to price in. So let's come down here. And when we talk about SPY, right? SPY is an ETF that represents the S&P 500. And when we look at the trades in SPY, one of the most traded, a lot of the trades are also coming in as hedges against other positions, right? So SPY, probably out of all the vehicles out there, all the vehicles that you could think of out there that exist, is probably the vehicle that's most used for hedging purposes against portfolio risks, right? So if you got high beta, short high beta stocks there, you might hedge some of it against SPY and so forth. So it's very hard. Lots of things going on in the SPY. A lot of people coming in, maybe hedging their portfolio risk, hedging strategy risks, or even speculating, right? So lots of stuff going on here. And what you typically see, and we've done this many times, is that a lot of the trades coming in, right? Most trades are coming in are those front month options, right? The expiring options. The expiring options basically are, that's it. It's not a long-term volatility play or long-term play on direction or anything. This is just on the day. People are trading them. It's over. They expire. So August 26th, that's it. They expire. They're gone, right? So it's nothing going out further in time for that expiring option. And it's very typical. If you watch this every day, this is typical behavior that, you got the August 410 puts, positive delta on balance, people selling options. August 409 puts, positive delta on balance, people selling options there. August 410 calls, negative delta on balance, people selling calls. 408 put. This 408 calls on balance. This here is nothing unusual than something you see every day happening in SPY, that when these expiring options come in, people just tend to sell these options around wherever at the monies. They just have a much bigger delta because they expired today, right? So once the options expire, it's either going to be 0 deltas, they're worthless, or they go to 100 deltas, meaning they're in the money at expiration. So, and I could go back in time, I'll reload it, but this is not anything unusual. Why are the deltas larger today? Well, there's more volume. It was more volume, bigger move. So the deltas were just proportional to the move and the volume on the day. We had a major market moving event, right? It's almost like a Fed meeting, because now they're kind of giving us an indication what they're seeing, how they're leaning, which kind of differed from where the market started to price in, where the market thought that maybe they're about to pivot, and they said, no way, not yet, right? So none of this here would have been anything that was unusual. If we go back here, I'm going to come down. Let me just scroll down. This is the deltas by expiration, right? So we could see a lot of it in the short term, and probably all the expiring, less than 5 days, created positive deltas, mostly from those put selling. But if you go out in time, a little bit further, you see a lot of, mostly right now, people were doing trades that were getting short, right? So this is, yeah.
Lauren was asking, while you're looking at the SPY, how do I check the probability of SPY finishing up or down after a gap down opening of 1% or more? Is there a way to look at when you've had the type of move that SPY had yesterday, I guess, how it responds days after? Is there a way to look at that?
In this, let me think about this. Let me try to.
Robert answers, and he says one way is to look under the volatility tab and go to implied moves. That gives you the implied move up or down on a historical basis. I don't think that's maybe what Lauren is asking.
Yeah, let me see. So he's looking at a historical gap down move, like a gap down or down day.
I see. He says gap down And he says it was the opening. I don't think the move was at the opening yesterday. It was kind of like all day, right? As Powell started.
Yeah, I think what happened was actually the market opened. It wasn't a gap down day, so the market opened kind of unchanged. What happened was it was the meeting, right? It wasn't like a shock in the morning. This was all, anticipated that there's going to be, the meeting that Powell's going to speak, that he's going to give a message like this. We talked about it for several days, and this was on CNBC. This was on, whatever financial, any financial publication that you could read was talking about this event. So it's not a surprise that the markets started to move after the start of the event and information was coming out. So it wasn't a gap down move, right? It kind of just started moving down as the event, as the event unfolded and people started to digest the information. So you could see here, we opened close to unchanged. It was kind of like as the day went on and more information kept coming in and people were readjusting their models to, potentially higher interest rates, how that would impact, their future revenue growth, earnings growth, discounted cash flow. All this then started to weigh in on the market as the day went on. So that's how it progressed here. So maybe another way to look at it is after a big, just maybe down day, large historical down moves. So you could see here, these are the 12 largest historical down moves in the last, I think, something like 3 years, 4 years. So we took down days, right, where the day of the move, you could see this was down 3.8%, 4%, 3.7%, June 20th, 5.8%. So these were the largest down moves. I think we're going back 3 years or 4 years. And we see here that on average down 5.7%. Okay, so 3.4% it's below these averages, but let's just use this as an example. So the next day after, you can see 58% of them were higher, 42% lower. So kind of a mixed bag there. A little bit slightly more days it finished higher the next day than lower. This is how it tended to do. So hopefully that helps.
Actually, Lawrence, and that he's getting into it. He's actually today's gap down. He's looking at the QQQs, and is down. He says 1% this morning. So I guess he's looking at the QQQs.
Yeah, and let me just take a look. That might not be a historical gap downs. So if we look at these opening gap, so it's not even in the, out of these, it's not considered even like one of these larger gaps. So it would be on the smaller side if we looked at these, but this is what it tended to do. Gap down by the end of the day, 58% of the time it did drift lower, 42% higher, but average return of 0.5%. So when it did drift higher, the magnitude of the up moves were higher than the magnitude of the down moves. But again, you could see here on average, these gaps were down 4.8% versus today's 1% is not that. It's not that big. It's probably big, but not one of the bigger gaps we've seen.
No, it's hard to think of a 1% move. It's not one of the biggest, right? I mean,
not that big, yeah. But we've been getting more volatility, and I do think as interest rates go higher, volatility will tend to increase because the bid-ask spread starts to widen out in general. And I'm not talking about the bid-ask spread of just an option or a trade, but where you're moving large volumes of stock, right? So the large volumes of stock moving will increase the volatility. And I think that we're going to start seeing that more volatility moving higher than we were used to when interest rates were zero and we were in an easy money environment. So let me actually, maybe, you know what, I'll show you guys an IWM trade that I thought was interesting. So, you know, so full disclosure, I did piggyback on this trade, all right, a very small one, but I thought it was, I thought it was interesting, and it kind of agreed with my thesis right now. So that's why I piggybacked on it. And my thesis right now, if you guys have been watching, is that I do think that when we're looking at the earnings yields of some of SPY, IWM, they're relative to the risk-free rate. I think that the spread between the earnings yield and the risk-free rate is tight. So it's really reflecting almost like a very positive, optimistic outlook right now. So there's not a lot of room for the downside. So when we look at the earnings yield right now on IWM, 3.2%, to me, an earnings yield of 3.2% with the 10-year at 3% and interest rates going higher doesn't make sense, right? So that means earnings have to grow at a pretty fast clip. And I'm not sure how the earnings are going to grow at a fast clip when the goal of the Fed is to slow down the economy, right? So we could, so I think that just that on a valuation basis alone right now, if you're pricing in a very optimistic viewpoint, and if you think interest rates are going to go up and the Fed will succeed at slowing down the economy, then then I think there's more downside risk than upside risk right now to the market in general. So I was looking, and unlike the SPY, the problem with if you're leaning short is timing, because that doesn't mean that the market will go down tomorrow or in a month or whatever. It takes time maybe to reality to catch up, because, well, what have we seen in our experience? That you could be right, but because of the timing, you're very wrong and you can't hold out. Right? So that's,
yeah, the timing can put you out of business.
I mean, put you out of business, right? So, and I'm not telling you guys to do this trade. Absolutely not. I just wanted to show you for demonstration purposes, why it kind of fit into my thesis and why I piggybacked it. And I didn't piggyback in size, just piggybacked it because I liked the trade. All right. And this happened 2 days ago. So I'm actually,
Robert, before you started this conversation, said one of the main people at Morgan Stanley stated this morning on CNBC that the next shoe to drop is compression in earnings due to rising interest rates and slowing economy.
Yeah, so people don't. Yeah, they don't realize how interest rates. They raise interest rates, but it takes time even for that to filter through the economy. The Fed told us that, right? That it's going to take 6 months to a year just to feel what they've done 6 months ago, a year. So we're not even feeling it yet, and they're not done. They. And I agree with the Fed. They need to keep, because right now they're too loose for too long. So now that inflation's gotten way overheated, they can't afford to be wrong anymore, right? They can't afford to stop and let it reignite. Like they ran out of those bullets. So they have.
One thing we've learned over our lifetime is you can't fight the Fed, right? And you can't fight the Fed. You were going to lose fighting them on the way up, and now as they try to slow inflation, you shouldn't try to fight them on the way down.
It would be I've never seen anybody fight the Fed and win, not in the long term. All right, let me see if I could find it really quickly and show you guys if I have time. So I'm going to go here on the time and sales. I'll show you what the trade was. So I think it was on August 25th. And this came across right here as unusual. So this was a time spread. Okay, so we interpreted that this time spread over here, June, our interpretation was that the trade was buying the June 21st, 2024 170 put, selling the June 16th, 23rd 170 put. Okay, so it was a time spread with a strike price of 170. All right, which was at the time, I think the stock was like around here we could see it, 195. So right away, we know that this has, because of the strike price, right, and you're getting long the time spread, it had a somewhat bearish bias. And why I liked it is that it went out far in time. So you're giving the market time to, react to reality of what the, higher interest rates and slowing down the economy. We didn't slow down the economy really yet, right? Because I think we have to look at that full employment, where we can't be at full employment and low productivity. There's an imbalance right now in the employment situation. So I'm gonna cue this up just to show you guys what the original trade looked like. So let's see. So right here, right on August 25th, I'm looking at buying the 170 put, going all the way out till the June 21st, 2024, selling the other put, the June 16th, 23, the year 2023. Right, so it's like they're a year apart, and it's $5.50 was the purchase price. So let's cue this up. I'm going to go to IWM. I'm going to come back. I'm going to come here to the options chain. August 25th. So this is when the trade happened. So the first part of the trade was, so these were the two expirations, June 16th, 2023, June 21st, 2024. So let's go out here first. And this was the first leg, okay? The 170 put, I'm going to show you guys here. The 170 put, see the 7,000, the 1028 traded at $14.36, with the stock 195.18, okay? So that's the first part of the leg. So let me do that first. Okay, buying the 170, right? And then I'm gonna go here, June 23rd. This is the second part of the leg. So let's go over here. So you see here, 7,000 contracts, 1028.48, hedge price 195, traded at $8.86. Okay, so that's the second part of the leg over here. So I'm going to load that strategy. So here's what it looks like at the first expiration. So you can see here that with the stock 195.40, you could see that it's a bearish because your sweet spot is right there, the 170 strike. So here's the market, 484.670, the midpoint 577. That's as of the close. The trade happened at $5.50. Okay, and that's where I was looking at from that $5.50. I think I did a 5.50 and even 5.25. Okay, so here's why I did it. I needed time on my side because it's going to take time for this to happen, which I think that slowly the Fed will win and bring down valuations because higher interest rates, lower earnings growth, all that will bring things down slowly. So I'm playing kind of like a slow drift down. The other thing, so I looked at, so at 550, I looked at what were these, what do I think this is worth? So I went to the IV Theo here, and I looked at, And this is capturing daily skews in the expirations and running a theoretical value where the implied volatilities are usually priced versus each other. So it's looking across not a skew vertical, but horizontal skew. And using the horizontal skew, we see that on average, historically, the spread was worth $6.76. So in my eyes, I'm already getting about over $1 discount from the average, $5.50, and it's going in the direction that my thesis, right? It's going in the same direction that my thesis. So historically, the low 480, high of 893, right now with the average around $6.76 using average horizontal skew, right, across time. So at 550, so let's take a look, come back here. So what were the prices here? You know, this is the market, 484, 670. I think the prices they use, let's take a look. So the first one, so 1436 and 886, right? So this one was $14.36. This one was $8.86. I'm going to rerun that. So here you go. That was done at 550. And if the implied vols just remain here at the same price and it floats to here to expiration, you know, it's about $1,200 we see in potential gains. So 2 to 1, right? Risking 550 to make 1,200. If you think implied volatility is going to go higher as it goes lower, which I believe it will, you're long Vega, so you stand to make even more on the Vega. So really quickly, I just kind of wanted to show you something that stood out, like SPY to me. There's nothing unusual. It really just behaved like it does every day at expiration. So I didn't see anything that was like out of the ordinary. But this trade, just to kind of show you, caught my eye because it did fit into my thesis. I'm not telling you guys to go do it. I'm just showing you kind of a quick evaluation of a trade that, you know, what would be unusual because I don't see these types of trades every day.
Well, that's great, D. The Chameleons really loved you walking through a trade. That was excellent. We did have one question and I know we're 5 minutes into the opening, so I don't want to hold you up here, but Alex was asking Dimitri, how do you see in the time and sales table the direction of the trade? Maybe we can just bring that up on tomorrow to answer that question. Or you could do it right now, however you want to do it.
Yeah, I mean, I'll do it tomorrow, but I just already know, I know the trade and I just know that a time spread, right? I know that it's a time spread, and I know the strikes are below the spot price. So on a time spread, if you're getting long the time spread, where's your optimal price point that's right at the strike at the strikes? So that's how I knew the direction. But you could put that up right here. That's why we have a payout diagram to assist you.
Perfect. All right. Well, thanks for the questions, everyone. It was a great show. Way to bring something super interesting as always, Steve. Thanks so much.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade and peace.